Hey everybody, wanted to take a few minutes. I'm going to try and do this in under 5 minutes, see if you guys can hold me to it. I wanted to take a few minutes and kind of walk through what we've seen the last couple of days with the Federal Reserve, with inflation, kind of what it means for real estate going forward. So let's start with yesterday. Yesterday morning, we got the monthly, what we call Consumer Price Index or CPI inflation report. This is the monthly inflation report that the news looks at and the biggest headlines came out of. That report came in softer than expected. And as you can see in this chart, that CPI report showed year over year inflation fell to 3.4%. Now, I should start to say that this is the core CPI number. What the core number means is it's taking out food and energy from the measurement because the Federal Reserve cannot impact their decisions cannot impact food and energy, right? Whether OPEC, doing things. So the Fed can't impact that. So it likes to strip that out. So you take those two things out, and you've got 3.4% year over year. That's a long ways down from where we kind of peaked at a little over 6%. So we've come a long way in that time. And so when you dig a little deeper inside the numbers themselves, what we found here is from a month over month perspective, the core number went up for May 0.16%. Now, obviously, you add those numbers together over the past 12 months, and that's how we got to that 3.4% number that we talked about back here. We add up 12 months worth of that. So last month was 0.16. But what I found was interesting is that of that 0.16, 0.18% was from shelter by itself. So what does that mean? If shelter was 0.18 and overall was 0.16, that means if you took shelter out of it, everything else would have been a negative number. So we would have actually had deflation on all other items except for shelter. Shelter represented 100% of the overall gain. It came from shelter. And so if you go back to that first chart that I showed, shelter year over year is hovering above 5%, almost 6%, according to this report. However, the problem with this report is that the shelter component lags by months and months and months. Shelter inflation was actually back here. It was very, very high, but the report showed it as very low, and it took a long time to catch up. How do I know that? Well, Apartment List does their own report, which shows current time frames and what's going on the ground. And what you can see, U.S. rents are actually down 0.8% in the last year, but the CPI number says they're up by almost 6%. So what that tells us is if Apartment List has accurate current data that's very low, in fact, it's negative, eventually that's going to catch up in this report, just like it caught up in the other direction when Apartment List said things are going crazy and this report said, no, everything's fine. So I thought that's a little interesting part because what we want to see going forward is lower inflation. The Federal Reserve has two mandates, one of which is to bring inflation down to 2%, the other of which is to keep a maximum amount of people employed as they can. So what I got wrong when I did my projections last year is I said mortgage rates are going to follow inflation. Historically, that has happened, and that's what I expected. Oh, we're at 4 minutes already. We're not getting this done in 5 minutes, but I'm gonna go fast. So the other part of the Fed's job is to manage and try to maximize employment for all Americans. So when I did my projections last year, I tied mortgage rates too closely to inflation. I didn't focus on the other side of the Fed's mandate, which is talking about jobs. And I absolutely went wrong in that because historically, when inflation is going down, people are losing their jobs, they're taking pay cuts, things like that. That didn't happen as we have gone from inflation, way up near 9% down to where it is today. We have not seen weakness in the labor market. And so as a result, the Federal Reserve has hiked rates and they've just left them there because the jobs market has been showing a lot of strength. A lot of strength in the job market usually means inflation. And so what they want to see, as counterintuitive as it may seem, is the job market slow down. And so one of the things that I've been keeping an eye on this year is I've really been focused on the labor data. And so this report came out this morning. This was the jobless claims. We get this report every Thursday. And as you can see, the 4-week average of people claiming unemployment for the first time has been climbing, right? We're at the highest levels that we've seen since October. And when we see this number going up, plus the inflation coming down, that means the economy is softening. And if you look at continuing claims, these are people who have been on unemployment and they continue to be on unemployment. You can see this number is going up. Now, this number, as you can see, has some volatility in it. But needless to say, the direction is still there. I prefer this 4-week moving average number to look at when we're kind of trending things out. But you can see things are starting to soften both on both of the Federal Reserve's 2 mandates, bringing inflation down and seeing the job market not be in a place where it's overly inflationary. I think that the Federal Reserve ideally would like to see this number somewhere around 300,000 before they feel like, okay, we got this thing in the bag. Now, if we go over that 300,000 number, where 300,000 people over a 4-week average are filing for unemployment for the first time, we're probably in a recession. They're trying to avoid that by doing what we call the soft landing, by trying to thread this needle by bringing inflation down without breaking the job market. Not sure they're going to do that. But in saying all of this, this is really good when it comes to mortgage rates. We've been dealing with super high rates we're going on our 3rd calendar year now, and we're looking for some relief. And so when I'm trying to play this out a couple of moves down the chessboard, I see the labor market softening and I see inflation coming down. Those 2 things are really good for mortgage rates. And mortgage rates are really, really closely tied to the 10-year Treasury yield. So 10-year Treasury bonds are something that I keep an eye on from a day-to-day basis. And when it comes to the trading of the 10-year Treasury, the trend is your friend, right? So the traders, like to see things in a certain direction, and it takes a lot to break through. So for example, if we were to go back to July of last year, when this number goes up, rates go up. When this number comes down, the rates go down, right? So if I were to draw a line in this scenario, you can see that when you create this line where, okay, the market's kind of bouncing off of these levels, once it breaks through the trend, it becomes a trend in the other direction, right? So if we were to do that same thing as rates got better going into the beginning of the year, okay? Let's do that again. There we go. So as they kind of bounced off this hypothetical line in the sand, as soon as it broke through, sure enough, we went the other direction, which is where we are now, where we've seen interest rates go up into the mid 7s since the beginning of the year. But let's play that forward to today. If we draw that line to kind of where things have been bouncing off of, as you can see, last week we kind of came through that. And now it looks like we might be starting a new line, because if we break through this, the trend is our friend, and hopefully we start to see things come back down again. If we can reach back down to this level, right, where we were kind of at the end of last year and some spots over here, I believe that, in that scenario, we likely will see rates probably around 6.5. Which would be great for us, right? And so if you fast forward to today, we're at about 6.85 nationally is the average locked interest rate. I think we have some room to run here in the short term to get down to 6.5. And what that means for real estate is what you can see here in Solano County is we're reaching kind of the 2017 through 2019 levels of inventory in terms of homes available to buy. This is about 600 homes for sale. That's kind of where we're headed to. This would be good for us if we could get interest rates down into the low 6s and we could see an inventory in this range. That's where we start to get a fair market for both buyers and sellers. Because if you think about the tail end of 2019 all the way through COVID, when interest rates were super low, it wasn't fair to buyers because there was such little inventory available. Well, you can see this here. So few homes available, yet we had low interest rates, which brought incredible amounts of demand. So people were bidding 10,000, 15,000. I had one, we bid $100,000 over asking price, and sellers were in control. On the flip side, if you fast forward to here in the summer of 22, after rates shot up from 3% to over 6%, sellers were kind of screwed up here because home prices were going down because there were so many homes on the market and interest rates had gone up so fast that there were very few buyers available to buy those homes. That drove prices down. If you go back 17, 18, 19, most of 19, this was a normal operating market where home prices were going up, but just at a small amount, right? Just a little bit. It was keeping up with inflation. That's great. Yet, people could afford to make their payments. Interest rates were at a reasonable level. So my hope is that if we can get interest rates down into the low sixes and we can see inventory continue to climb into this low 600 levels for Solano County, we would be in a really good position where everybody walks away a winner. So I am more hopeful than I've been in some time that we are headed towards a good place for both mortgage and real estate, and we'll see what that looks like coming to fruition. So I said 5 minutes and we're at 11. So I'm sorry, but hopefully you found this somewhat helpful. If you're not someone who's in real estate and looks at charts all day and you hear things on the news and you're like, what the hell are they talking about? Hopefully there was some value that you got out of this. So we're excited about what comes forth. And if I can be of service, please let me know.